Assalamu alaikum. I am Umar. I hope you are all well. Today's topic is about capital asset and pricing model. Before starting the video, I request to all my friends to subscribe my channel and press the bell icon. Let's go to today's topic. We have different website open. Let's take a look at one of them. The capital asset pricing model or Capm is a financial model that calculates the expected rate of return for an asset or investment. Capm does this by using the expected return on both the market and a risk-free asset, and the assets correlation or sensitivity to the market beta. There are some limitation to the CAPM, such as making unrealistic assumptions and relying on a linear interpretation of risk versus return. Despite its issues, the CAPM formula is still widely used because it is simple and allows for easy comparison of investment alternatives. For instance, it is used in conjunction with the model portfolio theory (MPT) to understand portfolio risk and expected return. Understanding the capital asset pricing model (CAPM). Investors expect to be compensated for risk and the time value of money. The risk-free rate in the CAPM formula accounts for the time value of money. The other components of the CAPM formula account for the investor taking on additional risk. The goal of the CAPM formula is to evaluate whether a stock is fairly valued when its risk and the time value of money are compared with its expected return. In other words, by knowing the individual parts of the CAPM, it is possible to gauge whether the current price of stock is consistent with its likely return. Capm and beta. The beta of a potential investment is a measure of how much risk the investment will add to a portfolio that looks like the market. If a stock is riskier than the market, it will have a better beta greater than one. If a stock has a beta of less than one, the formula assumes it will reduce the risk of a portfolio. A stock beta is then multiplied by the market risk premium, which is the return expected from the market above the risk-free rate. The risk-free rate is then added to the product of the stocks beta and the market risk premium. The result should give an investor the required return or discount rate that they can use to find the value of an asset. Capm example for example, imagine an investor is contemplating a stock valued at $1,100 per share today that pays 3% annual dividend. Say that this stock has a beta compared with the market of 1.3, which means it is more volatile than broad market portfolio. Assume assume that the risk-free rate is 3% and this investor expects the markets to rise in the value by 8% per year. The expected return of the stock based on the CAPM formula is 9.5%. The expected return of Capm formula is used to discount the expected dividend and capital appreciation of the stock over the expected holding period. If the discounted value of those formula cash flow is equal to $100, then the Capm formula indicates the stock is fairly valued relative to risk. Problem with the CAPM unrealistic assumption. Several assumptions behind the CAPM formula have been shown to not to hold up as in reality. Modern financial theory rests on two assumptions. Securities markets are very competitive and efficient. That is, relevant information about the companies is quickly and universally distributed and absorbed. These markets are dominated by rational, risk averse investors who seeks to maximize the satisfaction from return on their investment. As a result, it's not entirely clear whether Capm works. The big sticking point is beta. When Professor Gwen Pharma and Neth French look at share return on the New York Stock Exchange, the American Stock Exchange, and Nasdaq, they found that the difference in betas over a lengthy period did not explain the performance of different stocks. The linear relationship between beta and individual stock returns also breaks down over short period of time. These findings seem to suggest that Capm may be wrong. Estimating the risk premium, the Capm and the efficient frontier scroll on it further. Capm and the security market, practical value of the Capm. Who came up with Capm? What are some of the assumptions built to the Capm model? What are some alternatives to the Capm? I hope you like the video. See you into our next video.